Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.
Hello and welcome to ETMarkets Crypto Q&A. I'm Aloni Bhatt. Today we have Parth Chaturvedi, lead crypto ecosystem at CoinSwitch Kuber, who will respond to all your questions. Now, Parth is a crypto native since 2018, and before his role at CoinSwitch, he was a management associate at FalconX, which is a digital asset trading platform headquartered in the US.
Hello, everyone. This is Parth Chaturvedi, crypto ecosystem lead for CoinSwitch Kuber. We've been doing these set of like informational videos, Ask Me Anythings, where we pick up like a particular topic from the cryptocurrency world and dive deep into questions regarding the same. And today's topic is of much interest to everyone on stablecoins. So today we'll be discussing what exactly are stablecoins and why have they become so popular, and how can they be like unstable in the case of UST Terra, which happened about like a month back. So first questions first, what are stablecoins and why are they popular? So a stablecoin is a cryptocurrency or a virtual digital asset that is pegged or backed by a reserve asset. So the reserve asset could be a fiat currency, could be another commodity, or could even be like different cryptocurrencies altogether. So anything that is backed or pegged to a reserve asset can be called a stablecoin. The most popular ones are usually, backed by the US dollar, since the dollar is the reserve currency of the world. So most of these stablecoins work with some kind of, linkages or pegged to the US dollar. So the way that these backings and peggings are structured, because of them there are different kinds of stablecoins. There are popularly three different kinds of stablecoins. One are asset-backed stablecoins, like real-world asset-backed stablecoins. So these would include Tether, USDT, or USDC, the Circle dollar. Basically, here like each stablecoin is backed by fiat currency in the bank accounts. Although the auditing for the bank accounts is subject to the stablecoin provider. In the case of Tether, there are some questions around like the total backing, whereas in terms of USDC, is supposed to be more transparent of the fiat backing. The other kinds of stablecoins are stablecoins that are backed by crypto assets. The primary example here are DAI, which is the stablecoin for MakerDAO. DAI basically allows you to put ETH and MKR as collaterals for issuing, the stablecoin DAI. And finally, there are like stablecoins which are algorithmic stablecoins that are not really backed by real world assets as such. These are the ones where smart contract programming sort of helps bring about the peg in the stablecoin. The primary example for this was UST or Terra, which had like a huge implosion in the last month. We'll talk about that in more detail coming up. So what's the entire concept of creating, a stablecoin? A stablecoin is simply a tokenized variant of the reserve asset, such as the US dollar. What it does, it facilitates seamless cross-border transactions, improves, the arbitrage opportunity, and generally results in a more efficient crypto ecosystem. So once they are paired with like a reserve asset, they have become like a fungible token of sorts and have some value. This makes them, tradable, exchangeable at a much more efficient pace. So a related question to this would be, why not just use fiat to transact over exchanges where fiat to crypto conversion is already possible? Primary reasons is that, even in the centralized exchanges that take fiat, it takes a lot of time to get this processed. Versus their tokenized versions or stable coins, they are like standard, blockchain built tokens, and they are much more efficient in terms of transaction speed, terms of transaction finality, and hence are preferred by even centralized exchange users. Besides centralized exchange, if you go into the world of DeFi, stablecoins become extremely useful because they act as like the utility tokens for this entire ecosystem, where you can place purchase and selling orders using these stable coins across different platforms. So again, a lot of people consider that like BTC was originally envisioned to be like a peer-to-peer payments networks. So why are we relying on stable coins to fill the transaction void of sorts? So currently, what we would like to call BTC as as asset that sort of reserves value. So it is still in that phase where it is discovering the actual value that BTC should have. That is why it remains like extremely volatile, and the prices move so much on a daily basis. Daily, what even on a minute or second basis. So it doesn't make sense for BTC to be used as a payment currency as of now. Even for handling regular transactions, you would want something that has more stable value, and that is what brings us to the case in point, which are stable coins. Look at BTC as more like a digital gold of sorts, where the fixed supply schedule and the limited supply ensures that it will become like an inflationary hedge in the longer term. So whenever we talk about stable coins, there is always the discussion around pegging and depegging. So what exactly are these things? So a connection between a stable coin and the concerned reserve asset is called a peg. So you could be pegged to the US dollar if you're a stable coin which is pegged to USD, or you could be pegged to pound or euro as well. So one of the most popular stablecoin issuers, Circle, has announced that they will be launching a euro stablecoin soon. So whenever 1 unit of a stablecoin that was supposed to be equal to 1 unit of the reserve asset deviates from that value, which could be higher or lower, we refer to that phenomena as depegging. The primary example is the one that we saw recently when the UST Terra depegged from the dollar, and its value went from supposedly $1 to for some duration of time under 10 cents. So most people ask this question around what are the go-to reserve assets for stablecoins. Now, as I mentioned in the beginning, that stablecoins could be asset backed by real world assets, by crypto assets, or they could not be backed by any assets, like in the case of algorithmic stablecoins. Where they are backed with reserve assets, they can have standard fiat reserves. So the examples that I gave in the beginning, Tether and USDC, where dollar deposits are the underlying reserve asset. Similarly, there could also be some stable coins that are backed by commodities, more specifically like gold. So basically, like a crypto representation of gold prices is a gold backed stable coin called Paxos Gold, PAXG. And the most commonly used example in the crypto world, where crypto assets backed a stable coin, there the example is DAI, which is MakerDAO's platform stable coin. And generally the reserve asset there is either ETH or MKR, the MakerDAO governance token. Is there any other way to peg a stable coin without real world assets? Yes, there is. And this is what I mentioned in the beginning. They are generally referred to as algorithmic stablecoins, where a set of code or algorithm or smart contracts enable the peg to remain in its place. They are generally how do they even work is the next obvious question. So algorithmic stablecoins use encoded smart contracts to maintain the intended peg. That is the tracking of the currency that they are pegged to. This is primarily done by managing the supply of the stable coins in circulation. This is generally this process requires a balancer token. So it is generally a system of two tokens, where one is the algorithmic stablecoin and the other is the balancer token. In the case of UST Terra, UST was the stablecoin and Luna was the balancer token. How does this function in the real world? So basically what happens is that you have in the case of Luna, I'll try to explain that in detail. The algorithmic design allowed for users to convert one UST into dollar one worth of Luna, irrespective of the market prices of both assets. So what this means is that Luna supply contracts when there is demand for UST. And if there is like increased demand for UST, there will be a continued shrinkage in the supply of Luna. This will result in Luna prices increasing, and arbitragers can come into play to help peg the price of the stablecoin UST. Similarly, the opposite way would be if demand for UST goes down, new Luna would be minted, and that supply would increase. This would result in the peg going back to its normal. However, this during the phase that we witnessed in the implosion of the UST peg, what happened was like the demand for Terra UST kept on decreasing, and in place to try to bring that peg back to $1, more and more Luna was minted into the system. For context, like there was around 300 or 400 million Luna in circulation, and in just about a couple of days, that number went beyond like 6 trillion, resulting in a massive fall in the prices of Luna. And similarly, the UST peg was never really restored. The key important point in like algorithmic stablecoins is the arbitrage opportunity for arbitragers to come in and like basically get the peg back. But this was lost during this implosion of the Terra Luna system. So if cryptocurrencies are supposed to be volatile, how do crypto-backed stablecoins try to get their stable peg? The primary example being DAI, which is a USD stablecoin, but it is backed by ETH, or the native currency of the Ethereum ecosystem. So how this is generally done is that they are always over collateralized. Crypto collateralized or crypto backed tokens are generally they're over collateralized to combat for the price fluctuations that we see. So let's say if you want to purchase DAI from MakerDAO using ETH, you must deposit $1,000 in the form of ETH to get $500 worth of DAI. So the over collateralization ratio here would be twice. Keeping more than the asset value as collateral to combat volatility and uncertainty is termed as over collateralization, and this is the norm in case of any crypto backed stablecoin you will see in the real world. Why use stablecoins? Like, what are the different use cases of stablecoins? So other than if you keep the transaction value aside, stablecoins are used for crypto lending, staking, and even as a store of value. Primarily what we've seen in the recent past is that for decentralized finance, because they don't have the sort of fiat to crypto payment rails that centralized exchanges do, decentralized finance has been seeing a boom of the usage of stablecoins. This was one of the primary reasons that drove up the usage of UST Terra, because there was a DeFi protocol called Anchor, where a lot of yield was available for UST. So in the last 6 months or so, we saw UST Terra increase in circulation from less than $1 to almost all above $10 billion. So primarily, why are stablecoins used in DeFi? Because they are cryptographically secure, they are native to the blockchains and the ecosystem, and they are programmable and composable. So you can have smart contracts built on top of these stablecoins within DeFi. Again, one of the first questions that we get asked about DeFi is how can you lend a stablecoin? So the relatively stable nature of stablecoins makes them, a good interest earning asset in the form of, you can go to different crypto lenders and earn interest. So the primary examples here would be Aave, which is like a DeFi platform specifically focused on crypto lending. This is very similar to, keeping money in the banks and getting an interest rate in return. Similarly, you can go with your stable coins deposited in an Aave liquidity pool and get returns for providing that liquidity. Related to this, some people try to question like that they think that if BTC is a store of value, how come like stable coins also be like a similar source of value? Think of stable coins as stores of value in the sense that you would consider a currency to be a store of value. Like dollar is a better store of value than most emerging market economy currencies, because how they're relatively placed to each other. So a dollar denominated stablecoin could be a store of value for somebody in India where the INR value keeps on decreasing versus that particular stablecoin. Plus, in addition to that, in stable coins, you can actually deploy them to like these DeFi protocols and earn yield in the process of yield farming. Sorry to confuse you, but yield farming is another concept that I would like to just touch upon. It is basically locking up your assets or value to a liquidity pool on primarily like decentralized exchanges. And because of the liquidity that you provide, those decentralized exchanges like help in easier movement of funds. So what the decentralized exchange basically does is that it rewards you for providing that liquidity to the pool. This is generally like a small fee percentage of the total size of the pool, the amount of liquidity that is being drawn out from the pool at any given particular moment of time. Stable coins help you get the corresponding crypto from a place where fiat finds it hard to reach. This is like, again, like I go back to the point where DeFi has really like resulted in a boom in stablecoin usage, and like yield farming in general has attracted a lot of fiat to be converted to stablecoins and deployed in these DeFi protocols. Another related question that we get is around the similarity between stable coins and central bank backed digital currencies or CBDCs. So at the onset, I would like to say that no, stable coins are nothing like CBDCs. Instead, CBDCs, remember, they resemble like standard cash reserves, only in a digital form. Released, assigned, and regulated by a central monetary authority or framework. A CBDC is just like a legal digital tender of official fiat currency. Stable coins, on the other hand, are crypto or virtual digital assets. They are just pegged to a reserve asset that has a fixed value and like a steady growth profile. So again, like a CBDC has to be a US dollar. If the US digital dollar is being used as CBDC, it has to be minted by the Fed. It has to be legally recognized by the Fed. Whereas in the case of stable coins, any number of entities can issue stable coins, but their backing could be from like a US dollar or euro, even other cryptocurrency. So in that very sense, they are very different from each other. So as I mentioned in the beginning, that DeFi has really led to like a boom in the use of stablecoins. A related question is, can stablecoins facilitate crypto adoption? For sure. Like stablecoins, how they ensure crypto adoption is by bringing more credibility to the space and allowing for faster, transmission of funds between people across the globe. Overall, like what investors do is, once fiat is brought into the crypto ecosystem and they don't want to invest in any particular asset as such, they can just like hold that value in stable coins and deploy it whenever they see any opportunities coming. With the overall stable coin circulation now staying neck to neck with exchange traded crypto for the past 3 years now, the effect has been, and will continue to see, like more positives coming out from stablecoin. Overall, like stable coins and circulations are well above 60 billion now. In fact, we have now reached a point where 15% of total digital asset market cap is in the form of stable coins. This could also be seen as a sign of the current market situations, where a lot of investors are ready to wait it out and sit in cash positions and deploy those stable coins into digital assets once they see like a more favorable opportunity. A lot of stablecoin discussion has happened in the recent past, primarily after the implosion of the UST Terra ecosystem. So a related question to that is, will Terra's debacle discourage the stablecoin market? Uh, Not on an overall level, but it has been definitely detrimental to algorithmic stablecoins, where there is a balancer token that tries to maintain the peg for the stablecoin. Their adoption might come under like more scrutiny, and people will be much more risk averse in investing their money in such stablecoins. But on the contradictory side, we have seen like a steady growth in the USDC deposits. So the Circle USDC token, the stablecoin, which is like very transparent in how it gives out details of the assets backing the stablecoin, has seen like continued growth in the recent 2 months or so. So we will see like increased adoption of collateralized stablecoins becoming more and more popular. However, again, like a point to highlight is USDT Tether, which is the most popular stablecoin, has seen like major redemptions in the last 2 months because of their murky or less transparent declarations of the assets back. So we've been seeing a flow from USDT Tether to USDC, which is much more well-regulated and more transparent. And at the same time, we've seen like algorithmic stablecoins see a massive reduction in terms of interest and investments. So can stablecoins be risky? By the very name, stablecoins should be stable, but what we saw, they are anything but stable in the recent Terra fiasco. You must understand that different stablecoins are structured differently, and the volatility of the underlying asset or the any kind of smart contract or code malfunctions can result in their value being away from the peg, or depegging to happen. So the asset-backed stablecoins generally will move with the market movements, and their central stablecoin repositories will be ensuring that their value is captured. But this centralization also results in some kind of security risk that comes with it. That is why the search for a true algorithmic stablecoin will continue, because of the fact that being decentralized, it allows more and more robust framework for DeFi to operate in. In the recent past, we have seen USDD, or the Tron dollar, really take off after the collapse of the UST stablecoin. USDD again focused on DeFi, providing very high yields, attracted a lot of capital right after the Terra implosion. But we saw a similar depeg happen with the same coin when the broader market saw a sell-off. So on the whole, like, just stay do your own research about algorithmic stablecoins, and only then put your money there. Whereas in terms of more well-known and asset-backed stablecoins like USDC and USDT, you should make sure that you do your ample research in terms of what are the assets that are backing them. Do a timely review if they are falling in any way, they're falling short of their redemption requirements. So that is the broader take on stablecoins. As we continue to see DeFi becoming more mainstream, more institutions getting into DeFi, we will continue to see the uptick in the usage of stablecoins. Thank you.
Well, that's it from us. Hope this was all informative. Now do write into us at ETMarkets Crypto Corner with all your thoughts and questions. From all of us, goodbye.
Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.